Daily Bread with Tom Hartman. I'm your host, Tom Hartman, for November 17th, 2025. Look, normally when we speak on these Daily Breads, it's about market updates and what has happened recently. And a big thing has happened recently, and that is Bitcoin has at least touched below 90,000. And if you've been watching me for a while, you know that 92,000 was basically my line in the sand for Bitcoin. And below here, if we get a confirmation of it below here this week, looking for a bear market for Bitcoin. Now, given the fact that Bitcoin is my liquidity indicator, it does speak volumes to what's happening, right? What it means to me is that we are potentially headed for a recession. Um, One second here, folks. Just want to make sure the microphone is working properly. All right, perfect. So the issue here is that I have been paying attention to several years now to market flows and dynamics. I'm not an expert in the field, but as a retail trader, I like taking a look at it to see, hey, what's going on? What season are we in? And for a while now, I've been knowing that winter is coming, right? And I thought this could be either this fall or March of next year. And we're seeing some warning signs here that maybe the cards are in play, the wheels are in motion for it to be this quarter. Now, what am I talking about? I'm talking about there's this dynamic within the markets, as you've seen, where the market keeps going up and to the right. I've been talking about this, screaming at the top of my lungs about this very frantically in very fun way on Sunday Fuels as Sacred Profit. But it's a very real dynamic that's happening because of passive investment flows within the markets. This is a concept that I learned from Mike Green from Simplify Asset Management a number of years ago when he did an interview on Real Vision. And ever since, the idea has just been absolutely fascinating to me. The idea of markets going up for a reason that's beyond the value, the valuation of the stock, and that we may have a downside to that as well. So for the next week, I'm going to be talking about this. I'm going to be talking about what I call the negative gamma spirit bomb. Spirit Bomb comes from a Dragon Ball term. This is an anime, if you are too cool for school, in which the hero Goku is able to amass a massive amount of energy, larger than he's able to normally conjure, by calling on the forces of all the other beings on the planet, all the other humans, animals, plants, and so on, and then uses it to defeat an enemy. We saw a small version of this in markets during the whole GameStop AMC thing that happened during COVID, where the Wall Street Bet Reddit people got together, thousands of people got together, and they were able to cause a positive gamma squeeze. And sorry, forgive me, it's a negative gamma squeeze, but to the upside on call options to drive the stock so high that the shorts were squeezed out. There was this dynamic that was there that caused people to make massive amount of money, and more importantly, really wreck the GameStop chart. A similar thing can happen again. And this has been brought up by Kem Carson from Kai Volatility, who states that, it's one of his fears that people are going to understand that they could potentially do this, get together in large numbers and cause a GameStop, but not to the upside, to the downside, and to the entire stock market, or at least to the big names of the indexes, that it's possible to cause this negative gamma squeeze down to the downside. Now, we would need a few conditions to be true. And these are certain conditions that I've been paying attention to, been watching to see, hey, can these all sort of occur within the same time? Now, this is not an exhaustive list, but this is really my short list of things to pay attention to. One, recession. Right? So we're looking for a recession here where people are losing their jobs and less money is being spent into the passive investment space. and they become sellers because people will need money to live, and they start selling their assets indiscriminately. 2, in a GameStop style, in a Wall Street bet style, retail en masse come together to buy zero dated options for the indices. Just massive amount of gamma that is created, negative gamma. That's where dealers and market makers who are short these puts, because they're selling these puts to retail, they have to go and hedge their position by selling in the markets. Rise in VIX, so that this could trigger Vanna and Charm flows. Illiquid markets, where the price valuations are so high or the liquidity is not there in order to support the dampening of the volatility. Fed hesitation. This is where the Fed, who would normally come in with massive amounts of liquidity, decide not to for any number of reasons. And lastly, that a catalyst occurs that really pushes the whole thing over the edge in a George Soros breaks the back of England sort of situation. And these things can occur. These things can happen. And I am worried that they're happening right now. So for the next 4 days, we're going to be talking about this so you can get on the same page as I am. And hopefully more information comes out that we're able to piece together to see, hey, is this really what we're looking for? Is this one of those winters that lasts all year? Now, to start with, I love going back to Mike Green. Mike Green from Simplify Asset Management is the one who introduced this idea to me. And we're going to watch a little bit of his video from 3 years ago on excess returns, where he talks about this actual problem and then dynamic. I need you to be on the same page as me. And so please enjoy a little bit from Mike Green on excess returns. One moment here. There it is.
Let's understand how big passive, where we've come from with passive in terms of the percentage growth over time.
Yeah. So this is one of these things that is actually really, it's actually really fascinating, because I can present it as being a relatively small problem, or passive being a relatively small component of the market. And I can also explain that it's giant, right? And so on a small argument, if I look at things like mutual funds and ETFs, the share that Vanguard holds, quote unquote, openly, for example, right? It appears that passive strategies are somewhere around 15 to 20% of the market. That's basically the retail ownership through ETFs and mutual funds. There's an entirely separate component of the market, though, that is actually much more passive than the retail side. So the retail side has become increasingly passive as 401ks and IRAs and registered investment advisors have been encouraged to guide their clients towards low-cost indexing products. But this happened a long time before and has reached much greater penetration in the institutional space. So if you think about your college that you attended, I almost guarantee you that if you call up the CIO of that endowment, they will tell you that they have a passive allocation for US equities that's held in the form of either a total return swap or in the form of what's called a CIT, a commingled investment trust, basically an unregistered mutual fund, or in the form of a separate account, et cetera, right? So all of these strategies incorporate passive components to them that'll then extend further into all the variable annuity products, and most insurance products, most structured products are using passive references, futures products, et cetera. And so the passive exposure in the market, on my calculations, has gone from less than 1% in the early 1990s to today it's somewhere in excess of 45% is the math that I come to.
Just imagine that. Just imagine that the passive flow participation within markets, it could be 45% and higher. This is 45% 3 years ago. It's higher right now. So that means it's a type of market participant buyers that are completely indiscriminate when it comes to price.
Right. And what that means is that now basically half the market in terms of its allocation is truly mindless in its mimicry of the supposed insights that are happening in capital allocation for the rest of the market. Again, doesn't necessarily sound like a terrible thing, right? Imagine the world where half of it is mimes, right? And half of it is really thoughtful people, right? So like that doesn't seem like
Let's move on to the next point.
That's a really bad outcome.
One of the things that you've pointed out is the changes that have been made in the 401k space with, I think, these automatic opt-ins and the vehicles that they are putting the investors or putting forward as the best vehicles for investors. So can you just talk to that a little bit?
So one of the dynamics that exists within passive, right, is that when you decide to buy the S&P 500, there are two reasons why you could decide to buy it. You could decide to buy the S&P 500 and all of the stocks that are in the S&P 500, all 505 stocks that are in the S&P 500, in proportion to their market capitalization. And you could decide to do that because you think that stocks are a really good thing to buy, right? Because it's March 2009 and stocks are really cheap. That's less of a concern, right? That discretionary thought process where you're actually applying some allocation schema that says, I think this is a good idea, right? That's not such a huge deal, although it does contribute to things like increased correlation of securities, et cetera, for very obvious reasons. If I decide to buy everything altogether or sell everything altogether, then they're going to behave more like each other than if I was deciding to just buy one and buy another one or sell one, et cetera, right? So you're seeing a rise in correlation associated with that, but at least it's somewhat thoughtful in its capital allocation process. The thing that really changed is in 2006 and then in 2012, as you highlight, the 401k space changed significantly. And it shifted from what used to be an opt-in system where if you were employed, you had to make a decision to allocate to a 401k, and then you had to choose what you were going to allocate to. And then on top of that, you had to be an investment expert because you were expected to maintain a certain allocation or change your allocation over time. And the data was fairly straightforward that the vast majority of people just did nothing, right? So when they went in initially, they were getting things like cash, right? They'd get a money market mutual fund. And only after several years on the job would they wake up and be like, oh, I wonder how my investments are doing. Wait, I'm still in cash. I didn't change anything. So in 2006, that changed with the introduction of what's called a qualified default investment alternative. That qualified default investment alternative is the product that you automatically default into when you go into your corporate 401k. And
that's the forced buyers issue here. That turns the entire workforce who have 401ks into forced buyers into the market. They just buy every week, every 2 weeks, automatically, sight unseen.
And likewise, the 401ks themselves changed from opt-in. In other words, I had to make an active choice to participate, to opt-out. I had to make an active choice not to participate, right? So that dramatically increased the amount of capital that flowed into the markets. Initially, they went in through things like balanced funds, like the PIMCO's, total return type products, right, where it's a mixture of bonds and equities. And then in 2012, that default changed to what's called a target date fund. And a target date fund is a systematic allocation process that literally asks one question: when do you plan to retire? Right? And with that one piece of information, then chooses how to allocate all of your capital. Right? So everybody who plans to retire at the same time gets basically the same underlying allocation schema. That now has changed something radically, because instead of me thoughtfully saying, hey, I want to buy the S&P 500 because I think stocks are cheap, it literally now is every 2 weeks I buy the S&P 500, not because I think stocks are cheap, but because I have a job. Right? That's changed the character of the market quite significantly and turned it into a very pro-cyclical dynamic. As long as people are getting more jobs, as long as more money is flowing in, you're seeing the dynamics of the S&P 500 or other risk exposures being bought on a continuous basis simply because people are employed.
So we have this setup of...
So just can you imagine that? That the market keeps going up and to the right no matter what because of these passive investment flows. So you can imagine how the government is and major market participants are all for this happening. They want more money to head into the market. And the Fed you would imagine in one way wants this to happen, that they want employment to stay low so that capital flows into the markets and assets keep going up in an indiscriminate fashion. Now, what happens the other way? That's the melt up scenario. What about the meltdown scenario?
Look at who the largest buyers were of these. Once they explode in price, the largest buyers have to be Vanguard, BlackRock, etc. And that's exactly what we saw.
On your point about the melt ups and
what he was ending there is the idea that once the stock becomes too expensive, like the share itself becomes too expensive, now people are priced out of being able to buy it except the large buyers.
the meltdowns. I mean, this was maybe the most eye-opening thing of all your research for me, because you're not talking about, a 20% decline or a 30% decline or a 20% increase or a 30% increase. I mean, you're talking about the market could go up 5x or down like Great Depression levels, right? Isn't that the degree of what you think could happen if this keeps growing?
Yes. And I understand that is incredibly distressing to people, but the way I describe it is we are in a car that is driving uphill with no brakes. Right? Doesn't matter as long as you're going uphill. Once you start going downhill, that's when you really miss those brakes, right?
Terrifying. Absolutely terrifying. That you could have volatility so high that you can end up with a market that's 5x higher than you would normally expect in any other regime, and then all of a sudden so low that it's at Great Depression levels. Wow.
Right. So, the warnings were largely ignored on the way up. And now as we're going down, I would argue that a lot of people are like, what in the world is going on? Well, you're starting to see some of the dynamics of a market that is extraordinarily exposed to market participants who only buy if they receive cash, right? There is no cash held in reserve. There is no, hey, I think Palantir is really cheap now that it's fallen from $35 or $40 to $9 or $7, whatever the number is right now. Or I really think that Microsoft having fallen 20% or Apple having fallen 20% or any number of energy companies, like there's just no analysis that's actually being done on that. Vanguard is not, that's not entirely true. They do have active funds, but there's nobody sitting there at the Vanguard Index Fund who's like, wow, did you see that Apple earnings report? That's a really great earnings report. We should buy more Apple. They don't care. They just don't care.
This might be a question
All right. Well, this interview and other interviews like it from Mike Green has, I revisit every few months just to make sure that I keep them in mind. Definitely worth a watch, definitely worth a listen. You want to go take a look at it. And it's from 3 years ago, so see all the updates since then, which we'll take a look at a little bit at the end of this week. But what I also want to touch on later on is this idea that we are one of the main things that we're looking for the setup for what we're talking about, this meltdown, this crash down, this massive volatility spike down, this negative gamma spirit bomb it starts off with recession. It starts off with people losing their jobs, and we're seeing that happen. And regardless of whether it's AI taking the jobs over, robotics, or whatever it is, that money is not going into 401ks. Those people who lose their jobs are not going to go into 401ks, and there might be an expectation that they're not going back. So you can imagine that either fiscally or in a monetary policy, they're not going to change this all of a sudden to have money that flows into the stock market before a major crash happens. And they might not be thinking about just how massive the crash might actually be, that we could see down 50%. We can see down 80% all of a sudden. But who knows? We have circuit breakers for the stock market for a reason. 7% down, and it'll stop it. So at least that. But what happens in Bitcoin then? Who knows? Who knows? All right. We'll be back tomorrow when we talk about zero-dated options, one of the largest assets, tools, derivatives being traded in the space. And who is leading the pack on that? Of course, retail traders. And do they know all the effects that can happen because of it? I'm going to go with no. So thank you very much for watching. We'll be back tomorrow with even more Daily Bread. Thanks for watching.